All right, today we are going to tackle one of the most sacred cows in all of personal finance. The idea that you absolutely positively have to pay off your mortgage before you retire. But we're not just going to talk about feelings. We're going to look at it through a cold, hard mathematical lens. You've heard this a million times, right? From your parents, from articles online, maybe even your financial advisor. It's one of those golden rules that feels as solid as the foundation of your house. It's all about security and peace of mind. And hey, that's a great goal. But here's the question. What if that warm, fuzzy feeling of security actually comes with a massive price tag? What if I told you that in a lot of cases, holding onto your mortgage could actually make you way wealthier in retirement? That's the question we're going to dig into today, using the hard numbers. So first, let's just acknowledge why this advice is so dang popular. It's not complicated. It comes from a really simple and, honestly, a very powerful emotional place. I mean, this just feels right, doesn't it? The thought of heading into retirement with zero debts, with that house being 100% yours, that's incredibly appealing. But here's the thing. Smart retirement planning isn't just about what feels good. It's about optimizing. It's about making every single dollar you have work as hard as it possibly can for you. So let's do an experiment. Let's put emotion on the shelf for a few minutes and just look at what the numbers have to say. We're going to compare two totally different paths for a person who's getting close to retirement. Okay, imagine this is you. You've got 200 grand left on your mortgage, but you've got a fantastic interest rate you've locked in years ago, just 3.5%. At the same time, you've also saved up 200 grand in your brokerage account, which, let's say, has been earning a pretty standard 7% a year. So here's the $1 million question, or, well, the $200,000 question. What do you do with that cash? You're at a fork in the road. Option A is the traditional path. Take that 200K, wipe out the mortgage. Boom, you're debt-free, but your investment account is now at zero. Option B is the road less traveled. Keep the mortgage, keep making those payments, and let that 200K keep doing its thing in the market. So fast forward 15 years. What does path A look like? Well, you are completely mortgage-free, which feels awesome, and you've saved yourself about $57,000 in interest you would have paid. That's a guaranteed win. The downside, though, your brokerage account is still at zero. You've traded all that potential growth for a sure thing. Now, let's look at path B. That same 200 grand, left alone to grow at 7%, it turns into more than $500,000. Now, of course, you still had to make all those mortgage payments over the 15 years, but even after you subtract that total cost, your net position is almost $300,000 ahead. Just let that number sink in for a second. By choosing not to pay off that cheap mortgage, our friend here is almost $300,000 richer. This isn't just pocket change. This is the kind of money that completely changes what your retirement looks like. So, what is going on here? What's the secret? The magic behind this whole thing comes down to a really simple but incredibly powerful idea that every single person planning for retirement needs to understand. It's a concept called the spread. It's really simple when you break it down. You're borrowing money from the bank at a low cost, 3.5%. At the same time, your own money is earning 7% somewhere else. That positive difference between the two is your spread. You can think of it like your personal profit margin on your own debt, and that margin just compounds like crazy over time. Okay, now, this is really important. This strategy is not a magic bullet, and it's definitely not for everyone. It comes with some very, very important conditions. First, your mortgage rate has to be genuinely low. Second, you have to be disciplined enough to actually invest that lump sum, not just go spend it. And third, you have to be okay with market risk, because unlike paying off debt, investment returns are never guaranteed. So the theory is one thing, but let's see how this actually plays out for a few different people in the real world. First up, we have Margaret. She's got an amazing 3% mortgage rate, and she's a very disciplined investor. For her, the spread is a whopping 4%. Her money is working way, way harder for her in the market than it's costing her in interest. For Margaret, the math is crystal clear. The opportunity cost, what she'd be giving up by paying off that cheap debt, is just too high. For her, keeping the mortgage and staying invested is without a doubt the choice that could lead to hundreds of thousands of dollars more in her nest egg. Next, let's look at Robert. His situation is the complete opposite. He's got a much higher mortgage rate, 6.5%. This just shows how critical that spread is.
His potential return from investing is only 0.5% higher than what his debt is costing him.
So for Robert, the decision completely flips. Why on earth would you take on all the stress and risk of the stock market for a tiny, uncertain gain of 0.5%? For him, paying off that mortgage is like getting a guaranteed risk-free return of 6.5%. It's the smarter, safer move, hands down. And finally, there's Susan. Now, on paper, her 4% mortgage rate means she should probably invest. But she's retiring early, and her biggest worry isn't squeezing out every last dollar of return. It's having access to her cash if she needs it for an emergency.
For Susan, this decision isn't just about math. It's about life. If she uses all her savings to pay off the house, that money is now locked up inside her walls. It's not liquid. She can't easily grab it if the roof starts leaking. So by keeping the mortgage and the cash, she's buying flexibility and peace of mind. And for her, that's worth more than the potential extra gains.
So as you can see, there is absolutely no single right answer here. It all comes down to your specific situation. So how do you figure this out for yourself? Well, here's a pretty simple framework you can use. 1. Know your rate. Is it low or is it high? 2. Be brutally honest with yourself. Will you actually invest the money? 3. How's your liquidity? Do you have other cash you can get to easily? 4. What's your real risk tolerance? Can you sleep at night when the market drops 20%? 5. Don't just guess. Run your own numbers. And finally, number 6. Remember, this isn't an all-or-nothing game. You could always take a middle path. So let's circle all the way back to where we started. That old advice to pay off your mortgage isn't necessarily bad advice. It's just incomplete. It's a simple answer to what can be a very complicated question. It completely ignores your interest rate, your discipline, and your own personal need for security. The real goal here isn't to just blindly follow some old rule of thumb. It's to make a smart, informed decision that is right for you and your family. So take a hard look at your own numbers, your own personality, and your own priorities. What does the math tell you to do, and what does your gut tell you? Because the best answer almost always lies somewhere at the intersection of the two. Thanks for joining me.